cash management models. Friends, in cash management models, there are two theories that we have in our syllabus. Basically, the treasury and the cash management is like consisting of this additional concept regarding the management of the cash. First of all, let us have starting with the Baumans model. That is what we are going to start. That is, so the first cash management model, Baumans model. Why Baumans model? What was the situation because of which the Baumans model was invented? That is what we are going to understand over here. Over here, friends, first of all, we are going to understand the assumptions of the Baumans model. Only in that case, we will be able to understand the application of the Baumans model. So, first of all, having understanding the assumptions, and based on that, we will be able to understand why there is an invention of the Baumans model. The assumptions are like this. The first assumption is that annual expense of the company is evenly spread throughout the year. So, suppose like annual expense of the company is 36 lakhs and there are 360 days in a year. Then in that case, the assumption is made that 36 lakhs divided by 360, daily expense of the company will be 10,000. That is the first assumption. Second assumption is made that whatever the expenses of the company is evenly spread and whatever the amount that we are going to spend throughout the year is available with us at the beginning of the year. It means that if at all the expense of the company is 36 lakhs in a year, let us say that starting from January to December, then assumption is made that the entire funds is available with us on 1st of January. That is an assumption which is made over here. Now, we understand like this, that logically speaking, we know that only an individual and Hindu undivided family HUF are having their savings account. Except this two, nobody else is having savings account. Everybody else has like the current account. May it be a private limited company, may it be a limited company, may it be an association, may it be a trust or any other form. They always have such a simple the current account. Current account has two important features. One, there are no restriction on the number of transactions. You can enter into n number of transactions as far as the current account is concerned. However, there is a limitation. What is the limitation, friends? The limitation is that no interest is offered. Now you imagine logically that whatever the amount that you have at the beginning of the year, 36 lakhs, if at all you keep in the current account, then what will happen? That whatever amount that you have to spend later on during the year, for that you are having the availability on 1st of January and you have kept that in the current account. Current account will not offer any interest to you. So in that case, you will be losing the interest income on this amount of the funds. Keeping that unutilized funds in the current account will not give any interest income to you. That is what's the kind of situation that you have. So what will happen? Obviously, we will keep the funds in the liquid securities. And from liquid securities on regular basis, we will transfer the funds. In liquid securities, we are having a liberty that at any point of time, whatever the amount of the funds that you want to withdraw, you can withdraw and you will be given interest on daily basis. Now, be attentive. What happens over here, that whenever you will transfer the funds from the liquid securities to current account, you are required to bear cost per transfer. What is cost per transfer, friends? Cost per transfer means cost that you have to incur at the time of transferring of the funds. Let us say, for example, that you are having you are having an arrangement in which an employee will do this work, maybe on every 15 days or every 1 month, who is doing this work. Then in that case, whatever the time that he is giving for doing this work is consisting of or is considered as cost per transfer. Basically, we understand that there is no explicit cost for transferring of the funds. If at all you transfer the funds, say from that is your liquid securities to current account, then only you are required to pass that is the command, and with that the funds will be transferred. You have to do login, you are required to do some online transaction, you will receive an OTP, you have to insert the OTP, and the things are done. That is the way, so there is no explicit cost. However, whatever the time of the employee in doing this work, say, is an implicit cost for us, because that employee is doing number of work. So we are having say costing of that employee on per minute basis. So if at all he is giving, let us say 5 minutes of his time in doing this work, then in that case, say that cost is considered to be the cost per transfer. In addition to that, we understand that say whatever the infrastructure which we are using, for that say we are having a cost, office premises, office equipment that we use, so that is also having some amount of the cost. And so for that say we are required to compute say the cost per transfer. In addition to that, we understand that say whatever the internet, whatever the electricity which is used, for that also we are having say some allocation of the expenses, and with that say we make the computation of the cost per transfer. If at all you want to connect this concept with your say concept of the economic order quantity, you can connect, that is connected, because this Baumans model is taken from the EOQ concept only. In the EOQ concept, you are having cost of placing an order. Whatever the cost of placing an order itself is the cost per transfer. Irrespective of the quantity for which you place the order, so the cost of placing an order is remaining same. In EOQ, same is the case over here. Irrespective of the transfer size, always cost per transfer is going to remain same. That is what we understand. So over here, so the cost per transfer will remain same irrespective of the transfer size, and it is calculated like this. Now giving some further explanation to you friends. Suppose an annual expense of the company is 36 lakhs. There are 360 days in a year. So daily expense of the company is 10,000. Now we are talking about the transfer size, because once you are making the investment in the liquid securities, then on a regular basis you are required to transfer the funds from your liquid securities to current account. Based on the different transfer size, you will have the different total transfer cost. Suppose you keep the transfer size of 1 lakh rupee. Now what will happen? 36 lakhs divided by 1 lakh. So how many times you are required to transfer the funds? Correct, 36 times. It is 36 lakh divided by 1 lakh. So like you are required to do the transfer say in a year for 36 times. Every time you are incurring an expense, that is cost per transfer. So 36 times into cost per transfer, product of both of them will give the total transfer cost. So it can be calculated like this friends. 36 lakh divided by 1 lakh, so it comes to 36 times into, let us say cost per transfer is 1000 rupees. So in that case what will happen? 36 into 1000, it comes to 36,000. Now if at all the transfer size is 4 lakhs instead of 1 lakh, then what will be the total transfer cost friends? Correct, 36 lakh divided by 4 lakhs, that comes to 9 transfers in a year. Cost per transfer will remain same, 1000 rupees. 9 into 1000, that comes to rupees 9000. So the total transfer cost over here will be an amount of rupees 9000. 36 lakh divided by 4 lakh, that gives 9 transfers into 1000 rupees cost per transfer. So in that case 9 into 1000, it comes to 9000. And if at all the transfer size is 18 lakhs, what will happen friends? Again it is simple, 36 lakhs divided by 18 lakhs. So there are 2 transfers in a year. Into 1000 rupees, that comes to rupees 2000. Now at this point of time, being management of the company, suppose you have to decide that which transfer size. Is it an amount of rupees 1 lakh or 4 lakhs or 18 lakhs? Then in that case, taking into account say this total transfer cost which we have calculated, obviously you will select 18 lakhs. However, the story does not end over here. The reason for that is that say apart from the total transfer cost, you are having total carrying cost. Because as I told you that this concept is similar to the EOQ concept. In EOQ we know that say for the different quantity of the raw material for which you place order, the total cost is different. If at all you place order for more quantity, then in that case you will be having less number of orders, and with that the total ordering cost will decline. You can see that over here, if at all you keep the transfer size of 18 lakhs, then in that case you have to do transfer only for 2 times in a year, and your total transfer cost will be only 2000. In comparison to that, if at all you keep the transfer size of rupees only 1 lakh, then in that case the number of transfers will increase. However, with that say what will happen? Carrying cost will be less. What I want to tell you is that say the total transfer cost and total carrying cost have inverse relationship. With the increase in the transfer size, number of transfers reduce and total transfer cost also reduces. With the increase in the transfer size, total carrying cost will increase. That is what we understand. So over here we understand that say for the different transfer size, the total cost is going to be different. Now, can you tell me that what is the use of the Baumans model? Can you tell me what is the use of Baumans model? Yes, you answered very correctly that say for the different transfer size, we know that say the total cost is going to be different. So by using the Baumans model, we are going to make the calculation of economic lot size. Economic lot size means such lot size, such transfer size at which the total cost is going to be lowest. And that is what we understand is the Baumans model. This concept is same as EOQ. For the different quantity for which you place the order, total cost is going to be different. Total cost is consisting of 2 costs. One is the total ordering cost and another is the total carrying cost. So by using the EOQ concept, we try to find that what is the economic lot, economic quantity for which we should place the order so that the total cost is the lowest. And for that, say we have this concept. So this is what say we are going to have, so the understanding over here. Now I am showing you a few slides for the assumption, and then we are going to do so the numericals. That is what we have, friends, in the subsequent slides. Baumans model, it is a cash management model. It has made following simple assumptions. First, annual expense, it is assigned a variable of the company is evenly spread during the year. B, whatever amount to be spent during the year is available with the company at the start of the year. Cost per transfer and the rate of interest will remain same. Cost per transfer will remain same irrespective of the transfer size. From company point of view, amount to be spent during the year should not be kept in current account, because in that case there will be a loss of interest to the company. Rather, the company should invest entire amount in liquid securities and on regular basis it should be transferred to the current account. For different transfer size, total cost consisting of total transfer cost and total interest cost will keep on changing. So by using Baumans model, we are going to calculate economic lot size. Question number 7, consider following information. Annual expense of the company is 3,60,000. There are 360 days in a year. Cost per transfer is rupees 500 and the rate of interest is 10%. Calculate the total cost if the transfer size is 10,000 and if transfer size is rupees 90,000. So over here in this question, we are required to calculate the total cost for the 2 different transfer size. One is 10,000 and another is 90,000. So for this two different transfer size, we are required to compute the total cost. We understand that so the total cost is consisting of two items. One is total transfer cost and the second is total carrying cost. Annual expense of the company 3,60,000. Every time we transfer 10,000 rupees. So there will be 36 transfers in a year. For one transfer the cost is 500. So 36 into 500, it is 18,000. Similarly for 90,000. 3,60,000, every time we withdraw 90,000 rupees. So there are 4 transfers in a year. Cost per transfer is 500. So the total transfer cost will be 2,000. That is the way the total transfer cost will be calculated. As far as the total carrying cost is concerned, for that, say we are required to apply the formula similar to EOQ, in which we understand it is Q divided by 2 into CI. Instead of that over here, transfer size divided by 2 into rate of interest. Transfer size divided by 2 is indicating on an average the balance that we have in the current account. So transfer size divided by 2 into rate of interest. So 10,000 divided by 2 is 5,000. 5,000 into 10% comes to 500. 90,000 divided by 2 is 45,000. 45,000 into 10% comes to 4,500. That is the way the total cost will be calculated for different transfer size. Let us see the answer. Friends, over here, the objective of keeping this question over here is to give you say explanation about the concept, explanation about the working that we are going to do. Let us see the answer of the question, friends. Answer of the question is like this. Calculation of the total cost for the different transfer size. 10,000 and 90,000. Total transfer cost, for that the formula is A divided by transfer size into O. 3,60,000 divided by 10,000, that is 36 transfers in a year, into 500, that comes to rupees 18,000. For 90,000 rupees, friends, 3,60,000 divided by 90,000, that comes to 4. 4 into 500 comes to 2,000. Next, total carrying cost. Transfer size divided by 2 into rate of interest. 10,000 divided by 2, that comes to rupees 5,000 into 10%, that comes to 500. 90,000 divided by 2, that comes to 45,000 into 10%, that comes to 4,500. So for 10,000 the answer is 18,500 and for 90,000 the answer is 6,500. That is what we understand. Friends, at this point of time, if at all we have been asked that between these two, which transfer size will you select? Then you will select 10,000 or 90,000. Yes, the answer is 90,000. Why? Because the comparatively the cost is less over there. However, at which point of time the cost is lowest, for that say we are going to use Baumans model. Yet we have to understand that say how to apply the Baumans model. At this point of time, I am giving an additional explanation to you. You can see that if at all the transfer size is 10,000, which is lower than 90,000, then what will happen? Number of transfers will be more and the total transfer cost will be more. Further, we understand 10,000 is lower than 90,000. So in that case, on an average balance will be less and the carrying cost will be less. 90,000 in comparison to 10,000 is more. So what happens that so the number of transfers reduces and in that the total cost also reduces. That is what we understand. What I want to tell you, friends, is that total carrying costs and total transfer costs always have inverse relationship. That is what we understand. So now we are going to make the computation of like the economic lot size by understanding the concept of Baumans model. Baumans model says very simple that if at all you try to save one expense, other will increase. If at all you try to save the other expense, then this expense will increase. Like that, say both of them are having inverse relationship. So what you should do, you should balance both the expenses. It means you keep the transfer size in such a way so that say the total transfer cost and total carrying cost are same. That is the way you should be keeping the transfer size. If at all you keep the transfer size like that, then in that case the total cost is going to be lowest. That is what the model says. By using which formula you can do that, so that is also what now we are going to understand in our subsequent slides. The formula is exactly the same as you study in EOQ. Let us see our subsequent working, friends. Giving some explanation along with the formula, we can observe that TTC, total transfer cost, and total carrying cost always have inverse relationship. So if company will try to save total transfer cost, total carrying cost will increase and vice versa. So the company should keep the transfer size in such a way so that total transfer cost itself is total carrying cost. At the same time, total cost will be, that is at that time, total cost will be lowest. It is calculated by a simple formula as under. The formula is 2 into A into O divided by rate of interest and square root of the same. Explanation of the formula is like this. Total carrying cost itself is total transfer cost. Total carrying cost is transfer size divided by 2 into rate of interest. Transfer size divided by 2 will give on an average cash balance. Total transfer cost is A divided by transfer size into O, that is cost per transfer. Now friends, transfer size from right hand side is converted to left hand side, so it becomes transfer size into transfer size, remaining everything is transferred on the right hand side. So we have, so the final answer, like the final formula, as 2 into A into O divided by rate of interest and square root of the same. Question number 8. Consider following information, same information as question number 7. Annual expense 3,60,000, there are 360 days in a year, cost per transfer 500, rate of interest 10%. From above information, calculate optimum transfer size of the funds or economic lot size of the funds or transfer size of the funds as per Baumans model. Second question, calculate the total cost if lot size equals to economic lot size calculated as above. So friends, over here there are two questions. The first question says that calculate the economic lot size. So we understand that, say, by using a formula which we have just understood, 2 into A into O divided by rate of interest and square root of the same. With that, we will compute the economic lot size. At that point of time, total cost will be calculated and it is consisting of total carrying cost and total transfer cost. Whatever the answer that we get, say for this, it will be compared with the answer of the previous question. In the previous question, we have found, say, the total cost at 10,000, total cost at 90,000. We can see that, say, at 90,000 the cost is comparatively less. It was 6,500. However, over here in question number 8, whatever the total cost answer that we are getting should be lower than 6,500. We'll see that whether the answer is lower than 6,500 or not, and with that, so we'll try to test the Baumans model. Let us see that, say, how to make calculation of answer, friends. Answer of the question by using the simple formula 2 into A into O divided by rate of interest and square root of the same. 2 into A is 3,60,000 into 500 divided by 10%, square root of the same, and it comes to rupees 60,000. Calculation of the total cost, total carrying cost plus total transfer cost. Transfer size divided by 2 into rate of interest plus A divided by transfer size into cost per transfer 500. 60,000 divided by 2 into rate of interest 10%. 3,60,000 divided by 60,000 into 500. So 3,000 plus 3,000, it comes to rupees 6,000. We can see that an amount of rupees 6,000 is lower than 6,500. Further, this 6,000 rupees of the cost is equally divided between both of them. What do you think? Is it a coincidence or always it will happen like this? Friends, always it will happen like this. Why? Because the basic formula is given, say with that concept only, that you keep such transfer size at which both the expenses are same, at that point of time the total cost is going to be lowest. If at all the company is keeping any transfer size other than 60,000, the total cost is going to be more than this. That is what we understand. This is the concept of Baumans model. Let us see next question, question number 9 friends. The annual cash requirement of A Limited is rupees 10 lakhs. The company has marketable securities in, highlight the portion, lot size of 50,000, 1 lakh, 2 lakhs, 2 lakh 50,000 and 5 lakhs. Cost of conversion of marketable securities per lot is rupees 1,000. The company can earn 5% annual yield on its securities. You are required to prepare a small table indicating which lot size will have to be sold by the company. Also show that the economic lot size can be obtained by Baumans model. That is the question. So friends, over here the question says that, so you are required to make the computation of like a small table in which say you will mention of course one, total transfer cost, and second, total carrying cost, and based on that say you have to recommend which lot size will have to be sold by the company. So what we will do friends, we will make the computation of the total cost. The option which is having say the lowest cost will be selected. That is the way we are required to say do selection over here of the economic lot size. In the first part of the question, we don't have to apply the Baumans model. From the given lot size, so we are required to select one of them. That is the way we are required to do the answer. Annual requirement is 10 lakhs divided by lot size. That will give us the number of transfer of the funds. So 10 lakhs divided by transfer size will give the number of transfers into O, that is 1000 rupees. Then transfer size divided by 2, that will give us as we understand that's on an average cash balance into rate of interest. That is the way the total carrying cost will be calculated. Let us have understanding of the answer. Answer of the 9th question, let us see friends. Calculation of the total cost for the different transfer size. For 50,000, 10 lakh divided by 50,000, so there will be 20 transfers in a year. Into 1000 rupees cost per transfer, so it is 20,000. Carrying cost is 50,000 divided by 2, that is 25,000 into 5%, that is 1250. 20,000 plus 1250, total comes to 21,250. Like that we are required to make the calculation of the total cost for the different transfer size. For 50,000 rupees, we can see that the number of transfers will be 20. 10 lakh divided by 50,000, so 20 transfers. Multiplying with 1000 rupees is the cost per transfer. So the total comes to 20,000. Plus 50,000 divided by 2, average balance is 25,000 into rate of interest 5%. Accordingly, we are required to make the calculation of the carrying cost. And so on, the calculation will be made for the remaining transfer size. The transfer size at which the total cost is lowest is required to be selected. That is the way we are going to have the selection of the transfer size. For 1 lakh rupee, similar calculation is made. 10 lakh divided by 1 lakh, so 10 transfers into 1000, so the total is 10,000. 1 lakh divided by 2, on an average cash balance is 50,000 rupees in the current account into 5%, so 2,500. So total is 12,500. So on for 2 lakhs, 2 lakh 50,000 and 5 lakhs calculation is made. You can see that say out of all of them, so the lowest cost is at 2 lakh rupees. So we understand that so the company will be advised to keep the transfer size of an amount of rupees 2 lakhs. Like that, so we are required to give answer for the first question. The second question says that say calculate the economic lot size. Friends, what you can do, you can take help of the first answer to give answer of the second question. We understand that so the transfer size at which the total transfer cost and total carrying cost are same is the point at which we understand that the economic lot size is calculated. So over here the answer is 2 lakhs of rupees. That is what you can come to know looking to the answer of the first part. However, my suggestion is that always make the calculation. Always make sure that you write answer for the purpose of doing answer. So over here, the second part of the question, by using the simple formula, that is 2 into A into O divided by rate of interest, 2 into 10 lakhs into 1000 divided by 5%, and the answer comes to an amount of rupees 2 lakhs. That is the way answer of the question will be calculated, 2 lakhs of rupees. Let us see the next question. Question number 10. Explain Miller-Orr model of cash management. Let us have understanding of this new question. As we have understood that there are two types of cash management model. One is Baumans model, which we have completed. Second is Miller-Orr model. We don't have any numericals for Miller-Orr model, we just have theory. The very first thing that the Miller-Orr model says that we do not make any assumption with respect to that annual expense of the company is evenly spread throughout the year, because that is not the correct assumption. Practically, we do not have a situation like this. This model says that we agree that the expenses of the company is not evenly distributed. It keeps on rotating during the year. That is what it says. This model further says that we know that like always there is a peak season, there is off season. In that the expenses keep on changing. Further we understand that what happens that during the month, during first 10 days usually the expenses are more. For example, you will be having salary expense, you will be having rental payment, you will be having the wages payment and so on. EMI, like that the first 10 days of the month is having more cash outflow than the other 20 days. In that making an assumption that the expenses are evenly spread is not at all correct. That is the reason. We come with the theory wherein this assumption is not made. Rather, this approach says the company should determine 3 types of cash balance limit: upper limit, return point and a lower limit. There are 3 types of limit that the company should determine. Let us say, for example, just for the purpose of understanding, lower limit is 5 lakhs, return point is 7 lakhs and upper limit is 10 lakhs. I am just taking like a few figures to give you explanation. How these values are to be calculated, for that author has given formula. However, it is not included in our syllabus, so over here we are not including it. Otherwise, the formulas have been given with respect to determination of the upper limit, determination of the return point and determination of the lower limit. So let us say that the upper limit is 10, return point is 7 and let us say that the lower limit is 5 lakhs of rupees. The model says that keeping any cash balance between the upper limit and the lower limit, you start implementing the model. In a way that between 10 lakhs and 5 lakhs, you keep any cash balance and you start implementing the model. Suppose you are keeping the cash balance equal to the return point 7 lakhs and you start implementing the model. Now on daily basis you have to see that what is your cash balance. What will happen? Your cash balance will have the fluctuations. Sometimes it will go up, sometimes it will go down. Like that on daily basis you have to see that what is your cash balance. At any point of time, if the cash balance increases to upper limit, that is an amount of 10 lakhs, then what you should do, you should transfer such an amount to liquid securities from current account, so that transfer such an amount from current account to liquid securities so that the balance decreases from upper limit to return point. That is in our example 10 minus 7, it comes to 3 lakhs. So 3 lakh rupees will be transferred from our current account to liquid securities account. That is the way you should get a kind of reasonable cash balance in your current account. Again you continue with the business. Now if at all the balance increases, what you should do has been explained by the model. Instead of going up, suppose it is going down, it decreases to an amount of 5 lakhs. Then in that case what you should do? You have to see that do you have said that cash balance in the liquid securities? Do you have balance in the liquid securities? If yes, then redeem that investment. Redeem that investment to such an extent so that balance increases from lower level to upper limit. No, from lower level to return point. Correct. We understand that say you should redeem such an amount so that the balance increases from lower limit to return point. That is the way you should have the redemption. If at all you do not have balance in the liquid securities, then in that case you have to make arrangement of the funds say by any other means. However, you should bring up the balance from the lower limit to return point. So from 5 lakhs in our example, it will increase to 7 lakhs. Again you continue with the business. So balance is increasing, get it down. It is decreasing, get it up. That is the way you should be having the transactions to be done. That is what the model says. The model says that if at all the balance is in between the lower limit and upper limit, then neither investment will be made nor redemption will be made. Neither you have to invest the excess funds nor you have to redeem the investments that you already have made. This is what the Miller-Orr model. I am reading note with respect to the Miller-Orr model. It is again a cash management model. It does not assume that annual expense of the company is evenly spread throughout the year. As per this model, the company should determine 3 types of cash balance limit: upper limit, return point, lower limit. Upper limit is UL, return point is RP, lower limit is LL. The company should implement this model with a cash balance in between lower limit and upper limit. At any point of time, it may happen that cash balance increases up to UL upper limit. Then invest such an amount in liquid securities so that balance reduces to RP. If at any point of time cash balance reduces to LL lower limit, in that case withdraw/borrow such an amount from liquid securities so that cash balance increases to return point. So like that, say we are required to manage the cash. If the balance is in between the lower limit and upper limit, then no transaction to be entered upon. Now friends, we are starting with the homework section. Let us start with our question number 11. That is the first question in the homework. Question number 11. Prepare monthly cash budget for 6 months beginning from April 2017 on the basis of following information. So friends, we understand that we are required to prepare the monthly cash budget for 6 months starting from April. So from April to September, we are required to prepare monthly cash budget. Estimated monthly sales are as follows. January to October monthly sales is given. Though we have to prepare the cash budget only from April to September, we have been provided with more information. As per the classwork working that we already have done, friends, we know that number of times we require the information for the preceding or the later month. Again, my suggestion to all my dear students that try to do answer on your own first of all, and then you see the video. Of course, over here I'll explain you the entire question, and with that we will be doing answer simultaneously. However, you try to do answer on your own and then your answer to be checked with the video. Presently proceeding further, that's on monthly basis. Estimated sales have been given starting from January to October. Wages and salaries estimated to be payable on monthly basis. like for these 6 months information have been given that we require. Of the sales, 80% is on credit, 20% is on cash. 75% of the credit sales are collected within 1 month and balance in the 2 months. So for example, January month sales is 1 lakh rupee. Then out of that 1 lakh rupee, there is a bifurcation. 20,000 is cash and 80,000 is on credit. 20,000 rupees of the cash sales obviously received in the January month itself. Of that, so the remaining, that is what we understand is 80,000. Again, there is a bifurcation. 75% and 25%. 75% of 80,000 comes to 60,000. That will be collected in February and remaining will be collected in March. That is the way, say, we will be having, say, the collection. I repeat my explanation again. For example, April month sales is 1 lakh rupee. 20,000 is cash sales, so it is received in the April month itself. Remaining 80,000 is the credit sales. For credit sales, there is a bifurcation. Out of 80,000 rupees, 75%, that comes to 60,000. That will be collected in the month of May, your favorite month, and remaining will be collected in the month of June. That is the way the collection of the sales have been given to us. Reading further, there are no bad debts, that's great. Purchase amount to 80% of the sales and are made on the credit and paid in the month preceding the sales. So, the purchase is made in the preceding month and so the payment for that is also made. The firm has 10% debentures of 1,20,000. So 1,20,000 into 10%, per year interest is 12,000. Interest on these has to be paid, highlight the portion, quarterly, means every 3 months, in January, April and so on. It means that, say, there are 4 months in which we are making the payment. It is January, then April, then July, and then next will be October. We have to see that whatever the months for which, say, we are preparing the cash budget, whether any of the month is falling over here, yes, then in that case we are required to consider the payment of interest. 1,20,000 into 10%, that comes to rupees 12,000. Divided by 12, it comes to 1,000 rupees for 1 month. However, we are making payment for 3 months simultaneously. So 1,000 rupees per month into 3, that is 3,000 rupees. 3,000 rupees will be paid in the month of April. 3,000 rupees will be paid in the month of July. 3,000 rupees will be paid in the month of October and so on. So we have to see the number of months which are coming, say, within this time frame. The firm is to make advance tax of rupees 5,000 in the month of July. So in July, 5,000 rupees of the payment. The firm had a cash balance of 20,000 on 1st of April, which is minimum desired level cash balance. And further an adjustment is given. This adjustment we will read later on, friends, as and when it is required. Now, say we are starting with the answer. Friends, over here, we'll start obviously with the opening balance 20,000 rupees provided to us. Regarding wages and salaries, there is no adjustment. So on monthly basis, whatever the wages and salaries which have been given, that will be paid. Accordingly, we are required to show the payment of wages and salaries. So starting with the first adjustment, and for the questions, that is, say, that is showing you the question slide. Wages and salaries are estimated to be payable as follows. April to September monthly wages is provided to us along with the salary. Now solution, in that preparation of the monthly cash budget starting from April to September month. We'll start with the opening balance. Opening balance of 1st of April is given an amount of rupees 20,000. Friends, the remaining opening balances I have kept because later on it is required to be carried forwarded. Then payment of the wages. You can see that's the question. In that, the wages of April is 9,000, that is paid in the April. Wages of May 8,000. Wages of June 10,000. Wages of July 10,000. Wages of August 9,000 and wages of September 9,000. That is what we understand. Now I am showing you the question slide with respect to the collection of the sales. As I told you, 20% of the sales is on cash basis. Remaining 80% is on credit, and there is a bifurcation in which we are going to receive the amount. So let us see the question slide and then we will continue with the table. So the table is in continuation, but just your for your that is understanding, I am showing you the question slide, monthly sales information. So obviously we understand, as usually we start with the April month. April month sales is 80,000, of that 25%. Of that, say 20% will be calculated, and so that is going to be cash sales. We can see that so the information is given to us that 20% is cash sales, so 80,000 into 20%, 16,000 is cash sales. May month it is 60,000, so 60,000 into 20%, 12,000 is the cash sales. June 80,000, of that 20%, 16,000 is cash sales. July 1 lakh, of that again 20%, that is cash sales. Accordingly, we are required to show of the sales 80% is on credit, 20% is for cash, 75% of the credit sales. So of the credit sales, there is a bifurcation. Collected within 1 month and balance is collected in 2 months. Remaining information will be useful later on. Purchase amount to 80% of the sales and are made on credit and paid in the month preceding the sales. So that adjustment I will explain you later on. Interest has already been explained. So continuing with the table, friends, April to September, cash sales, as we understand it is 20% of the sales during the month. So 80,000 into 20%, 16,000, 60,000 into 20%, 12,000, 80,000 into 20%, 16,000, 1 lakh into 20%, 20,000, 80,000 into 20%, 16,000, 60,000 into 20%, 12,000. Then the collection of the credit sales. We understand that so the 75% is collected 1 month after the sales, like that information is given. Now we understand like this. Before April, it is March month. March month sales is given to us as 1,40,000. So whatever 1,40,000, of that 20% is for cash and the remaining is for credit. That is what we understand. So 1,40,000 into 20%, 28,000 must have been received, friends. Remaining is 1,12,000, that is the credit sales. So 1,12,000 into 0.75. You will see it is an amount of rupees 84,000 and that is collected in the month of April. April month, you can see that so the sales of the April month is 80,000. Out of 80,000 rupees, friends, 20% is cash, so the remaining 64,000 is on credit. 64,000 into 75% comes to 48,000. Next, after April it is May. For May month, sales is 80,000. 20% is cash, remaining is on credit, that is 48,000. Of that, 75% comes to 36,000. So what you can do, friends, you can make the computation directly also that 60% of the total sales will be collected in 1 month. How 60%? 100 into 80% of that 75%. That is the way so the calculation can be made. What we can do, friends, we know that out of total sales, 20% is cash is collected in the same month. Out of the remaining, we understand 80,000, there is a bifurcation, 75 and 25. So 75% of 80,000, that comes to, like if at all the total sales is 1 lakh, then 75% of 80,000 comes to an amount of rupees 60,000. So the 60,000 of 1 lakh is collected within 1 month. That is also the way you can do the answer, and accordingly, say further calculation can be made. You can see that as far as the June month is concerned, friends, June month sales is 80,000. So 60% of 80,000, that comes to an amount of rupees 48,000. That is collected in the month of July. July month sales is 1 lakh. So 1 lakh into 60%, that comes to 60,000. Then August, it is again 80,000. So 80,000 into 60%, that comes to 48,000. Now the turn of remaining 25%. So we understand that say 25% of credit sales. So it comes to 20% of the total sales. Whatever the total sales of that, so we understand 20% is on cash. So that is collected. The remaining 80,000, of that 75%, that comes to 60,000. And the remaining, we understand is like 25% of the credit sales. So 25% of the credit sales is 20,000. So 20,000 over 1 lakh. So like that we understand 20% of the total sales will be collected within 1 month of the sales. Accordingly we can understand. You can see that for the month of March, the sales is 1,40,000. If at all you compute 25% of that value, then in that case you will get the answer, friends. So over here all the internal explanations which have been provided to us, that how the collection is calculated, friends. Continuing with the table and remaining 25%. So 25% will be like this. Use a calculator again. It is 1,40,000, and of that you compute say 25%. That is the way, so you will get the collection. March month sales is 140 into 20% is cash. So the remaining is credit, that is 1,25,000. Of that 25% will be collected say later on. Now importantly friends, preceding to March, it is February. Whatever the sales of February, it is 1,20,000. Of that 20% is on cash basis. So 20% of that comes to 24,000. Remaining 96,000. Out of 96,000, 75% must have been collected in the month of March, and the remaining is collected in the month of April, and it is 24,000.